Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. Listen, everybody today thinks that as soon as the market falls just a little bit, that the Federal Reserve is going to come in and save the day. They also believe that inflation will subside. They also believe in unicorns. Well, today I'm going to show you the truth. I'm going to get into everything. Stick with me. One thing I wanted to mention was, did you know that there's a central bank today that is increasing interest rates in the triple digits? Yes, stick with me. US paying more to borrow as Fed raises rates, inflation stays elevated. So you got to remember something here. You've got inflation that's picking up just about everywhere, and as a result, central banks are increasing rates. Now, that could be on your credit card and it might be on your mortgage, but it's absolutely affecting the nations as well. In this case here, the Federal Reserve is increasing rates, and that means that the country has to pay more for its debt. Interest costs on national debt are up 30% this fiscal year and could increase more. So you will see right now, I'll show you just below, they give you the numbers. Government spending on net interest costs in the fiscal year that began last October totaled about $311 billion through May, nearly 30% increase. So this puts an additional burden on the government itself. And the government only has so much money to spend. And what does that mean? Well, in time, they're going to have to do one of two things, or even both things, and that is increase taxes or cut, and cut. What might they cut from? Well, that remains to be seen, but usually they like to increase taxes, and those taxes could be income taxes, they could be property taxes, or a combination of all of the above. Bond traders are trapped between recession and inflation fears. So many in the financial industry are finding it difficult to figure out where they are in this phase, where they are in the cycle. I'll give you that today. We'll talk about it. It's a tough time to be a high conviction manager. Yields have dropped amid growing concern about economic growth. So we've got these two things happening at the same time. And if you look at what's going on in the markets, a lot of times it doesn't represent reality. Isn't that the way it is? Look, I'm showing you the S&P 500, and we can see it over here. I drew these trend lines. I hope you can see that. But essentially, what we can look at over the next, let's say, week or so, depending on how strong next week is, we could start to see some resistance. And this will be a test, because what we were seeing, let's just say since the beginning of the year, has been lower highs. You could see that as I'm pointing with the mouse here, and lower lows for the most part. Okay, and that shows us a downward trend. Everything that's been coming up has let go. Okay, we watch this cycle continue as more fears of inflation, more fears of interest rate hikes, and all of this has been adding up. At the same time, we watch the market's reaction to it. And that is not just the S&P 500, of course. You're looking at the four broad US indexes, and it's showing the same thing. Okay, so we know that it is persistent. Now, what's different about these four broad indexes or the European markets, or maybe it's Japan, Australia, what have you, and China? What's China doing differently? Well, they're stimulating. That's right. They're giving it a little stimulus out there, and it seems to be having a very different effect than what we're looking at around the world. Isn't that so? Because you see China, their stocks have come up from after being beaten severely down. Okay? Let's take a look at the next aspect. I talked about the ECB and Euro, and you see here right now a little bit of humor. ECB action, policymakers in Frankfurt have a track record of hiking when others aren't. Okay, I just thought this was absolutely hilarious, this in particular. I don't know if you could see that. I'll try and draw it in for you. Right here, look at this. Okay, ECB hike into the sovereign debt crisis. So they're suggesting that perhaps we'll see a little bit of that hike, and then they'll have to come around. But this is the zero line. We are still below zero. And look at this marginal increase that they had. Is this humor? Are they trying to throw us a little bit of a curveball here in Bloomberg? But I get the point. I see what they're trying to say. And so you can see these cycles as we go and move back through history, as we zoom out. And it seems as though, if you look at it very carefully, that the central banks are doing their own thing. They're not suggesting we're worried about the stock market. If you notice it, they're not worried about the stock market. It's very important to see that. Okay? Inflation sparks global wave of protests for higher pay and aid. And we look at it all over the world. They mention many different examples, whether it's Sri Lanka, whether, there's many in here. You've seen it. I talked about Kazakhstan. I talked about Peru. I talked about Sri Lanka, of course. You look at all these different countries. There are riots. There are problems. And we see as inflation picks up, this is a natural response from people that if they can't afford to eat, they get real upset, isn't it? So that's where we are today. But unfortunately, because of the lack of financial education, and it's not just in some of these countries here, it's everywhere. What are we missing? We're missing financial education, which would have informed people that it isn't that we need pay increases. It's why does stuff cost so much money? Why is everything so expensive? Is it the greed of corporations? Sure, certainly we do see greed in corporations, many corporations. But is that why the prices have gone up so crazy? I don't think so. It's because of the activities of the central banks. And you see over and over again how they bring us through these cycles. All right, now that central bank that is going way out there, Zimbabwe. Zimbabwe plans triple-digit interest rate hike to tame inflation. My goodness. MCP member says the central bank inflation outlook is now 160%. Zimbabwe lending rates are already the highest in the world. You see, now, Zimbabwe is not the United States. Zimbabwe is not Australia and all this, okay? You know that. But it gives us a lesson that you can't screw around with your currency. You will destroy it. You will destroy it. And so you can have a country that is rich in resources. Maybe it's got culture. Maybe it's got history. Maybe it's got a big population. Maybe it has so many different things going for it. But you can screw it up in an instant. And that's so important. If you look at any of the hyperinflations in history, any of them, which includes 2 times in the United States, this can happen much faster than you think. A lot of times it goes from bad to worse in the span of a year. And I'm talking about real bad, like what happened here? People are questioning it. That can happen in 1 year. Yeah, that's, not overnight, but for a lot of people, it's too fast to realize it. The link between soaring food prices and political instability. And they show us 2008, 2011, and so on, and today we're even higher than that. You see what happens with food prices. People riot, people get upset, and they don't understand why it's happening, but they simply react. So I think that for a lot of people, number one, financial education, very, very smart. If you've got access to the internet, you've got access to people doing TikTok videos, dancing, or you've got the money GPS. You decide. Volkswagen chief warns economic damage from the war risks being worse than what we saw from 2020. I think it's important here to look at prolonged inflation and the effect it has on the supply chain and on you, the individual. So important to note that we are seeing some good signs coming up. We are seeing some factors that I would say are positive, and I'll share one of those in just a second here. But over time, it looks like we are witnessing a problem that nobody wants to acknowledge. central core issue, and that is the cycles of the central banks. They bring us through, and we are, slaves to it in a sense. I mean, it is really the case. But, all of this, we'll talk about that at the end. We'll talk about that at the end here. About 3.5 million households say that they are very or somewhat likely to leave their house in the next 2 months because of eviction. Over the last 12 months, rent increased by at least $250 per month for 6.7 million households. I mean, millions of people could be evicted. Millions of people are dealing with a crisis. Let's look at some of the facts. We're watching inflation picking up. Okay, what is that doing? Okay, rent's up, housing prices are up, food prices are up, and so on. 2 factors. We watch credit card usage increase significantly, and we've also seen this amount of savings that people have at really low levels today. All these things put together, you see where we are headed. And that's not a good thing. And you and I, we might be in an okay position because we're prepared, we're smart. But let's face it, our colleagues, our family members, our neighbors, a lot of them, are just not in the same mentality. They're just not wise to this fact. But I think that we should be prepared for ourselves in the best way possible. Hopefully, we can help out people in need. This is some of the interesting news. Toyota Motors is asking certain parts companies to cut prices for the July to September quarter, returning to its customary requests now that it expects output to recover soon. So Toyota, obviously a massive company, they believe that things are starting to ease. And if you look at the cost of freight, we have watched it come down from the absolute peak. It's still elevated. There's no doubt about that. But it has come down. And a few other things that have come down as well. Okay, so you're looking at BCOM, which is essentially a commodities index. That's the purple line. And you look at the yellow one. That's specifically the metals index. Okay, so metals have come down a lot. Very dramatic drop. And we watch along with that, commodities in general have come down. And looking at this is the S&P 500 compared to the metals index. And I thought it was interesting. I just wanted to note something. We've had this bounce in the S&P. If I just show you, this metals index heading down, S&P 500 heading up. Is there a massive divergence here, or will we start to see the S&P fall along with it again, and we enter in to the big D? What do you think? Are we going to see a big D? You tell me. Big D in our future? Yes or no? Let me know in the comments. I hope you appreciated this video. If you did, hit that thumbs up button. What I think people should be doing today is they should be getting prepared as best they can. Whether that's a bunch of extra cans of food, whether that's having solar panels on your roof, whether that's having good relationships with your neighbors, with your family and friends and other people around. A lot of people today have a skill that you don't have. One of the things I want to talk about more in the future is how to take the knowledge that you have and actually utilize that. Because a lot of people, they keep it inside, and they could be actually utilizing that skill to get something from somebody else, whether that's just money, or maybe you are an electrician, maybe you are a baker, and your neighbor, well, he grows tomatoes, or he has this skill or that skill, and you exchange that, whether it's money or whether it's skills or services or products, whatever it is. And now you have a relationship, and this benefits both sides. Both sides are happy for this. So I think more people should be aware that we should create our own economy that's, one-to-one. Okay. So that's my little rant for the end of this. I hope you appreciated this video. If you did, simply hit that thumbs up button. And don't forget to subscribe so that we can make it all the way to 282,000 subscribers. Thank you and take care.